I didn't go to Yale, but Roger Ibbotson is a professor at Yale economics, and he just wrote a very interesting article about how fixed index annuities may outperform bonds in the next decade. Okay, let's talk about this. What is a fixed index annuity? It's a guaranteed interest account. You put in $1 million, it's $1 million, et cetera. It's not subject to market fluctuations. Fixed means the principal is guaranteed. Indexed means whatever interest you get is indexed to some sort of index you like, the NASDAQ or the S&P or the Dow, whatever. Now, here's the key thing. And what Roger Ibbotson did, he runs a firm called Zebra for U.S. investors. Roger Ibbotson obviously is a brilliant academic. For anybody who's been ever in a financial office and seen those mountain charts of the money going up, that's called an Ibbotson chart. He became an expert on pricing different types of assets. I will tell you, after reading this, I do understand what he's saying. If you're a balanced investor, this specifically is for people from 50 to 75 years old. I mean, you're not an aggressive investor anymore. You're a balanced investor, which means you've got half your portfolio in equities and half is in fixed. That's a 50-50 investment. If you're a little bit more aggressive, maybe it's 60% equities and 40% in fixed. So here's what he says. He believes that rather than using bonds, which are subject to a lot of different pricing, in fact, if you own a bond and interest rates go up, your bond goes down in value, right? If you own a bond and interest rates go down, your bond goes up in value. But if you don't sell it, you don't capture that. So it's a management issue, but it's also a fee-paying issue. So if you have a balanced portfolio, let's use an example. If you're a 50-year-old, you got this portfolio, it's 50-50, you're paying 1% to your financial advisors. That's not outrageous, by the way. So you're paying $10,000 a year. And for the next 30 years, you're going to pay $300,000. Guess what? Roger Ibbotson says, replace the bonds with these fixed index guaranteed products and skip half your fees. So your fees go from $10,000 a year to $5,000 a year because you don't pay fees on these. So automatically you're 1% ahead. And by the way, over 30 years, if you can save $150,000, that's real money, even in New Haven, where Yale University is. So let's be smart about this. If in fact it's a better product, if it fits into your balanced portfolio, it can save you money management fees. And you still have the opportunity to change every time these things renew, every 5 or 7 or 9 years, whatever it is, right? Just like a bond. Instead of buying a 10-year bond for 4%, imagine if you can get a fixed guaranteed index product that can earn the same 4 or 5 and you don't pay any fees for it. So let's get realistic about balanced investing. Replacing the balanced fixed income portion with one of these fixed index products. Now, they're not all good, by the way. Let's be realistic about that. Now, I'm not doing a commercial for any one company here, but I do think that it takes a little bit of research. It does, I think, take qualified, financial professional who's got a license in that area to help you get one. If you want some pointers to the good companies that are out there, go ahead and email us, ask questions or whatever. I'll fill you in on what my opinion is on that after 50 years of looking at the evolution of products. So let's talk about how you can save fees, you can have a safer balanced portfolio, and according to Dr. Roger Ibbotson, it says outperform bonds. I mean, even if you outperform by 1 or 2%, that's like real money. So I'm Paul Mauro. Staying on top of what smart academic research has concluded in the financial business is just part of the art of being smart.